Good afternoon, all, and welcome to the webinar on monetary policy. So we have along with us Parijat Agrawal, our fixed income head. He will take us through the policy finer points, and then once he has shared his views, we'll open the forum for question and answer. Over to you, Parijat, sir.
Thank you, Ashay, and good evening to all of you, and welcome to this edition of MPC update and the way forward. So today, the governor, RBI governor, announced the MPC outcome. I'll share the PPTs and the various points. Okay, so as expected, the repo rate remains unchanged at 6.5, and accordingly, the standing deposit facility, which is 25 pips lower than the policy rate, remains at 6.25, and MSF rate, which is the marginal standing facility rate, which is 25 basis higher than the policy rate, remains at 6.75. Similarly, the stance was maintained the same which was there in the last policy. They decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target, which is 4%, while supporting growth. So, no changes, status quo. This was expected by the market that there would not be any change. There was some expectation that the MPC may change the stance from withdrawal of accommodation to neutral. But however, the four members decided to continue with the same stance. One thing very important to note here is that the decision to keep the policy rate and stance unchanged was 4:2. This means what? 4 members voted to keep it status quo. 2 members voted it against that decision. In the last policy, it was 5-1. This means that 5 members voted for status quo and 1 member voted for to change. So this time, 2 external members, Professor Verma and Adam Ashimagoel, they voted for a 25 basis rate cut and to change the stance from withdrawal of accommodation to to change it to the neutral stance. Now, as we go ahead, we'll see that what exactly the implication of this kind of voting means for the interest rates going forward. Now, first look at what was the growth projections for this financial year. So, in this MPC policy, the MPC looked at the last quarter of FY24, which came at 8.2%, which was extremely for the full year, and for the last quarter it was 7.8. So for the full year 8.2, and for the last quarter of FY24 it came at 7.8. So which was much higher than the expected numbers. So accordingly, the MPC has revised its GDP projections for the full year of FY25. So they have increased it by 20 basis point from 7% to 7.2%. For the last 2 policies, they had kept it at 7%. So for this year, for the year of FY25, they have increased it to 7.2%. There has been marginal changes quarter over quarter. So if you see from this slide, there has been increase in GDP projections every quarter by 10 to 20 basis points. Somewhere it is 30 basis points also. So for the full year, 20 basis points. Now, what were the factors which told or where MPC decided to keep the GDP growth projection upwards by 20 basis points? Let's look at that. Now, as I mentioned, the real GDP growth stood at 7.8% for Q4 FY24, and it was at 8.2% for the full year of 23-24. So now the various high frequency indicators are of indicating that domestic activity has shown resilience, and it is expected to continue to do so. The investment activity is likely to remain on track with high capacity utilization. Basically, it is one of the leading indicators that how much capacity utilization is happening. There is healthy balance sheet of banks and corporates. Both are deleveraged and very healthy. And there has been government's continued thrust on infrastructure spending, which we have seen in the last two budgets, and optimism business sentiment. So what we have seen is that private capex has also started to happen. Obviously not across all sectors, but in some sectors it is visible. The capacity utilization stood at 76.5% in Q4. See, long-term average, please notice 73.8%. So obviously, it is much higher than the long-term average. So that definitely tells that the growth is resilient and moving at a high clip. If you look at the GST collections, it has continued to remain very robust. The May number of GST collections stood at 1.73 lakh crores. It was 10% YOY. This means what? That my GST collection is also increasing, month over month. So these are the some of the factors I have just mentioned here, which prompted the MPC to upgrade their full year GDP projection by 20 basis point to 7.2%. Now, obviously, there are some risks to these assumptions. One is obviously some global economic slowdown, as we have seen that barring the US, the rest of the economies, advanced economies, the growth is a concern, and that's why we have seen some central banks have cut rates. There could be volatility in global financial markets due to geopolitical situations, and one thing which has started to come very prominently in all our discussions is that the extreme weather conditions, because that impacts the various agricultural produce. So food prices tend to be extremely volatile. So these are the factors which could disturb the projections that we have. If you look at the credit growth, it has remained extremely robust, almost at multi-year highs. So although it has slightly tapered, but it has continued to remain at closer to 16%, because 19.5 is with the HDFC merger. So if you strip that out, it is close to 15.9%. So it is at a multi-year high on the back of economic expansion has happened, increased capital expenditure, and obviously we have seen that the retail credit has been extremely robust. It's upwards of 25%. So that has been continued to remain at high year after year in the last 2-3 years that we have seen. Now, on the same side, we have seen that the deposit growth has although picked up, but it has started to taper off. So it is closer to between 12.5 to 13%. So obviously there has been a gap in the credit growth and the deposit growth. So obviously this will have some implications. Either the credit has to slow down slightly, or there has to be have some uptick in the deposit growth. So credit growth was also led by higher personal loan demand, what we have seen, and increase in lending to NBFC segment. So obviously, lot of factors or data points are pointing towards higher growth in coming quarters and years. Now, the next point to discuss is in the MPC was of inflation projections. So in this policy, the MPC decided to keep the inflation projection at 4.5. It is exactly quarter by quarter the same what it was in the last policy. So obviously the MPC wants to bring the headline inflation to 4% on a durable basis. So obviously if you see that in second quarter of this financial year, it falls below 4%, comes to 3.8. Obviously, this is more on the back of the base effects, but again starts to pick up to 4.6 and then 4.5. So for the full year, it has been maintained at 4.5. So if you look at for the last three policies, they are maintained at 4.5. So obviously, the projections are telling us that, the tight monetary conditions, the 250 basis rate hike has actually, helped in the disinflation, because that's why for the last three policy, the MPC has maintained their full projection at 4.5%. Now, what are the factors? Let's look at that. See, the headline inflation has started to trend downwards for the last few months that we have seen. It was at 4.83% in April, and then it was higher and higher at 4.85, and the previous months. The another the comforting factor for the MPC to keep the full year headline inflation at 4.5 is also because this inflation has happened more on the service side, and basically the core inflation. Now, core inflation is where you strip out food and fuel. So there, the disinflation has happened at a much faster pace, and it is lower than 4%. But obviously, on a longer period of time, it would converge towards 4%. So there is a lot of comfort and headroom for MPC to take any monetary policy decision due to lower core inflation. The core inflation is was higher in recent months due to volatile food prices. Non-core, basically, when you look at if you strip out the core inflation, what is there is that food inflation, because in a CPI, a large percentage, close to 50%, is food inflation. So food inflation has remained high and volatile because of the vagaries in the climate, as I had mentioned in my previous slides. So sometimes we see that vegetable prices going up, or cereal prices going up, or recently the milk prices have gone up because of extreme heat, or sometimes of unseasonal rains. So that has kept the food prices highly volatile and on upward bias. So that has kept the headline inflation closer to 4.5. So that's one key concern what the MPC highlighted, and obviously the entire focus of MPC on price stability to bring it down to 4%. So what are the various risk factors that even RBI's projection or would be that headline inflation remain at 4.5? See, the crude oil prices are a major factor because they import majority quantum of oil. So if the crude oil prices continue to go up, which looks unlikely because the global growth has slowed down, expected to slow down, and it has remained closer to $80 a barrel. So that's a good sign that it would help the disinflation further. Adverse weather conditions because of food, as I've already mentioned. Supply side shocks have started to emerge because of geopolitical tensions that we have seen. We have seen that with the attacks in the the Red Sea on the ships, and they have to take a longer route by way of going around the Africa. So obviously, supply side shocks could play spoil spot in the disinflation process, and obviously this may impact your global commodity and food price, because in the last 3 months the Food Agricultural Organization publishes a global food price index. So it has been on a rise for the last 3 months. So obviously these are the factors one has to keep in mind so that while projecting the inflation. The third aspect where MPC touched is on liquidity, because liquidity is extremely important. It acts as a lubricant for any monetary policy. So during the current financial year so far, system liquidity transited from surplus to deficit and back to surplus that we have seen. So obviously, there are various phases when liquidity is extremely deficit, close to 2 to 3 lakh crores, and then becomes slightly, the surplus also. So one thing we have realized that the deficit has remained much higher, but whenever it transited to surplus, it is a little smaller amount. So going forward, what we expect is that liquidity should ease with the resumption of government spending. The elections are over and the government is going to be formed. So obviously some spending would start happening, which was not happening for the last 1.5 months. That should add to the banking system liquidity. And then what happens that elections are over. So obviously currency in circulation also gets back into the banking system. So that should help to ease the liquidity deficit towards more on the neutral or surplus side. Looking ahead, RBI will continue to be nimble and flexible in liquidity management. They have been fine-tuning operations through both repo and reverse repo. They have been doing VRR and VRRR, both operations they have been doing to manage the liquidity so that the overnight rate remains at the policy rate, which is at 6.5. Recently, we had seen this news that RBI decided to transfer 2.11 lakh crores as surplus to the central government for the accounting year 2023-24. The interim budget, projected surplus of RBI and national banks close to 1 lakh crores. So obviously, a substantial amount has been transferred to the government's kitty. So this obviously will have impact on liquidity as well as on the rates and fiscal deficit going forward. India's foreign exchange reserves reached an all-time high of 651.5 billion as of 31st May 2024. So this also helps in adding liquidity to the system. So the point to understand here is that RBI is going to make sure that liquidity remains closer to neutral. Neither it would be very, very deficit nor surplus, because they want the short-term rates to remain closer to the repo rate, which is at 6.5. If you look at the foreign bond inflows, because this is how going to impact the interest rates or the yield curve going forward. So foreign investment in IGVs saw a remarkable jump with JP Morgan's decision to add debt to its indexes. And if you see that the bar graph, it was almost after more than 6 years that we saw additions coming in. Otherwise, it was always been outflows for the last 6 years. So that's again a healthy sign for the bond markets. The foreign investment net inflows into the IGVs has been in excess of 11 billion USD dollars since the announcement of inclusion in bond index. However, in the last few months, we saw some outflows also, small amounts. But the momentum of foreign flows is expected to continue across all asset classes due to strong macroeconomic fundamentals. That's what is visible. And this clearly it's showing in the numbers. Like you see that 2024 year till date, it is close to 525 billion rupees inflows which has come in. It was close to 699 in 2023. So definitely, the demand supply is more in favor of demand because more money is coming in, so more demand for the bond market, bonds. So we have covered what are the projections for growth, inflation, liquidity, and obviously the inclusion in various bond indices, FI money coming in. Now this slide is very crucial or important because we have just jotted down key fixed income markets are looking attractive, and what are the various points that make the fixed income markets very attractive this year and with the announcement of MPC policy and going forward. The real policy rate continues to be positive. See, we are at 6.5 policy rate, and MPC has projected the full year inflation at 4.5% for the last three policy rates. So obviously, we have close to 2%. So 2% is a very attractive real rate. Even if it is close to 1.25%, it is very healthy. So we are slightly much more than what is healthy number. So there is sufficient room for MPC to cut the rates going forward or the yields to come down. Second, global central banks have put a pause on rate hike, or have already begun the rate cut cycle. So if you see, yesterday was ECB, that Eurozone, the ECB cut the rates by 25 basis. Day before that, day before yesterday, the Bank of Canada cut the policy rates. So, few advanced economy banks, the central banks, they have cut rates, like Sweden, then Switzerland, now Bank of Canada, and the ECB. So obviously, it has started. The rate cut cycle has started. Now it is only a matter of time when the biggest of them all, the US Fed, starts to cut the rates. So, but in today's, the MPC, the governor highlighted, they do look at the Fed for directions, but they are not driven by their policy rate. They are driven more by the domestic, macroeconomic fundamentals on rate decisions. So, and recently, we have read all that S&P upgraded India's sovereign outlook to positive. So, this has happened after a very long time. So it has remained on stable for a very long time, but to move from there to positive is very, I would say, good news for the India and the Indian bond markets, because normally what happens is that rating agencies first move to positive and then do a rating upgrade. So the rating upgrade can be anywhere from between 6 months to 24 months. So based on the various macroeconomic data points which will come out, or the various data points which come in, so the rating agencies will take a call when to upgrade the sovereign rating. But this is extremely positive for the fixed income markets, not only fixed income markets, but for the entire India's economy. Why did they do that? Because the deepening economic reforms which you had seen, because the fiscal is consolidating, and high infrastructure investment, because that's very productive. The fiscal consolidation, which is again the one of the pillars for the fixed income market. For this full year, for the FY24, it was announced at 5.9 in the budget. Then again, it was brought down to 5.8. And when the final figure actually came, it was at 5.63. So obviously, the fiscal consolidation is actually started to happen. And for FY25, it has been kept at 5.1%. Now with robust GST collections, growth at 7.2%, this means higher revenue, higher nominal growth, and your higher dividend from RBI. The central government has enough room to bring down the fiscal deficit even lower than 5.1%. So obviously we'll come to know about this number when the budget is announced, I think by July, when the new government would announce the. But yes, the fiscal consolidation roadmap is there, and we are moving towards that. And that's one reason that why we believe that it got included in government the IGB bond indices, in the JP Morgan bond indices, and also the S&P upgraded India's outlook to positive. So this we expect to continue, but given the present evolving political scenario, the quality of expenditure needs to be watched. So that's what I mentioned, that once we have the budget and we have the various data points, how the government is going to spend that money, it would become very clear that what is how quickly, or what is the roadmap for fiscal consolidation. The increase in GSEC demand, as I mentioned that, we have seen in the last few months that government has cut down the T-bill auctions by 50%. So obviously, they have enough sufficient surplus with them to spend. Then they have done some buyback of bonds which are maturing in the near term in 2024 and 25. So obviously they want to prepay that. So obviously, the supply is coming down and the demand would remain very active, because demand is going to be very, very high, a from the active funds plus the passive funds, the money which will going to come in, because the passive funds have to put money if it is in the index. So with the inclusion in JPM index, the passive funds will have to put their allocation. So there will be more demand for G6, and obviously the supply is limited. So definitely it tells you that the yields are going to go down. Core disinflation has been steady. We have seen that core inflation has continued to fall, and this clearly says that the past policy measures have helped that in that disinflation. Current account deficit is expected to remain well within its sustainable level. Rupee stable, we have seen that it has been one of the least volatile currencies globally. So that also gives a lot of confidence to the FIs to put money in domestic market. Geopolitical risk, inflation trajectory, extreme weather conditions, volatile commodity prices, food prices are definitely, these are the risks. But they have been there for a long time now. But despite these conditions being there, what we've seen is that domestic macroeconomic conditions has continued to improve, because we are largely domestic economy. So that we have seen that it's happening. So our expectation is that it would continue going forward. In the near term, markets are expected to remain volatile because of the various factors I just mentioned. But from a longer term perspective, the entire fixed income market looks very attractive. Now, today the absolute yield levels are very, very attractive. Spreads are attractive from medium to long term, and M2M gains to accrue as rates start to soften and spreads starts to compress. So the total holding period return would happen. A, you have a very high accrual. B, the rate starts to come down. So obviously, you'll get M2M gains. And the third is that the spreads of the corporate bond, which is there between G6 and corporate bond, would also compress, because there would be more demand for them. So all put together, your holding period return would be very, very attractive. So these are some of the factors which we have just mentioned, that why the fixed income market looks very, very attractive. And continuing the same on this slide. Now the question to ask is that which are the funds which are going to be very, very attractive. So obviously my suggestion is that the entire curve looks very attractive, the yield curve. So those people who are willing to invest money for a short period, our liquid and money market funds are attractive, because invest in up to 1 year, 3 months to 1 year period. So short term yields are attractive because RBI has still not cut rates. Liquidity is closer to neutral to deficit kind of a thing. So short term rates are anchored to policy rates, basically 6.5 plus some spread. So there close to 7% kind of return is there today. That would happen, continue to be there till actually the rate cut happens. If you move further along the curve, the medium to long term, medium is your corporate bond, and long term is obviously the gilt fund and derivative markets. They look extremely attractive, because as I mentioned just now, your total holding period return. So if my accrual is at close to 7.5, and I'm running a duration of close to 9 years in my gilt fund, and even a 50 basis rate cut would add close to 4.5% roughly. So you can add that ballpark kind of return which one can get in the GSEC fund. So across the curve, based on the duration the fund is holding it, so the returns are going to be very, very attractive. So now, based on your investment horizon, risk profile, and ability to absorb the volatility, investors can come in across the yield curve. So that's all on the the fixed income outlook for the in the near to medium term. So thank you. I'll be happy to take any questions that if you have.
Thank you, Parijat, for an insightful view on the monetary policy. Parijat, there are a few questions. I'm just trying to club few of them.
Yes.
So the first question is like, where do you see the 10-year GOI by March 2025?
See, if you see this monetary policy, it was 4:2, which I just mentioned. Obviously, it tells me that somewhere around third quarter we could see some pivot of the policy. That next policy we could expect stance change, and then rate minimum 2 rate cuts to happen in this financial year. So obviously, if I'm looking at closer to say policy rate at 6, and then obviously 10-year could be closer to much lower than what it is today at 7 or 2. So we could expect to see somewhere between somewhere around 665 to 675 is definitely there. I'm just taking a spread of say 65 to 70 basis.
Okay. Parijat, the second question is like banks. So there has been a rise. The bank liabilities are raising because of the limits on the bulk deposits. So what impact it will have on banks' liabilities?
See, what is happening is that raising money through the fixed deposit is difficult. So it is a little long term. It is not so easy to do it. But the credit uptick is happening at a fast clip, which I just showed in my chart. So obviously, it makes more sense for them to go to the institutional market and take certificate deposits. Obviously, what happens, but you have to offer a higher rate. So that's the impact which they're having. So CDs are at around 3 month CDs at around 7.10. So that is the impact which they have. But in today's MPC, the RBI highlighted that banks needs to re-strategize this gap, because they're also concerned about the cost of borrowing which the banks are holding. So yes, their cost of borrowing goes up. That's the impact.
Thanks, Pari. The third question is like S&P has changed the outlook on India. It made it positive. And what impact that will have? And do you see a positive rate revision going forward?
See, as I mentioned, there are a lot of factors which prompted the S&P to change it to positive. First and foremost is that the quality of government's expenditure, which has been happening more on the infrastructure side, or rather than the revenue side. B, fiscal consolidation map, which we are doing it at a much faster pace compared to what. So it is expected that it should be 4.5 by FY26. So we are very well aligned to that target. It can happen. It can go much lower than that. So obviously our expectation, and plus the inclusion in bond indexes. So obviously the macroeconomic data points are telling us that the rate revision can happen sooner. So rather than wait for 24 months. But the risk is that the new government should not be populist measures and continue on that path.
Thanks, Barry. Another question, something similar, is like with this RBI's dividend and more money with the government, do you expect borrowings will reduce in the upcoming budget? They'll reduce the number earlier showed.
See, our expectation is that initially in the near term it may not be announced, but going forward, if the growth holds, which is being projected by MPC, so higher revenue could mean more money with the government, higher GST collections, and with more money coming in from the FIs in that the JPM index. So obviously government may not need to borrow, and with this inclusion, so they'll have to do a fine balance between expenditure and fiscal consolidation. So our assessment is that there could be a middle path where we'll do some fiscal consolidation and some, I would say that on the expenditure side. So obviously that there are high chances of probability that the government may cut down its borrowing by some amount. But that may be there or visible only in the last quarter of this financial year,
Okay.
not now.
Okay. The short-term rates have remained elevated. What do you see they to be easing going forward?
See, short-term rates are, as I had mentioned, are generally anchored to the the overnight policy rate and the liquidity in the domestic system. Going forward, we believe that some easing in this would happen because RBI is fine-tuning, government expenditure would happen, the currency circulation is going to come back. So there could be some easing, but not substantial till RBI cuts the rate. But there could be some easing in the short-term rates going forward because these factors will start to operate.
Thanks, Pari. I don't see any further questions.
Yeah.
We can conclude the call. Thank you so much.
Thank you.
Thank you, participants,
all.
for joining.
Thank you.
Thank you. Take care.